Welcome to the Deep Dive. For most of our lives, really, one symbol has dominated athletics, street style, everything aspirational globally. The swoosh. Nike. It's more than a company, isn't it? It's a cultural force built over decades on just unparalleled market power and what always seemed like this endless innovation. But things aren't always what they seem. If you've been following the business headlines lately, you know this giant, the world's biggest athletic company, isn't just slowing down, it's facing some severe financial and strategic pressure. So our mission today is pretty clear. We're diving deep into a comprehensive investment report on Nike, Inc. We want to look past the iconic logo, past the celebrity endorsements, and really understand the complex web of challenges facing them right now. We're going to dissect the pretty catastrophic failure of their DTC-only strategy, that multi-year pivot that just backfired spectacularly. We'll look at the fallout, the collapse in profitability, and, really importantly, analyze the rise of these agile competitors. Brands like On Holding and Hoka that are, directly challenging Nike's core identity as the leader in performance.
Right. What we're looking at here, it's a textbook case of a battleship turnaround. That's what the sources are calling it. When a company this huge incorporated way back in 1967 needs to change course, the sheer scale, the complexity, it's immense. And the sources, they paint a really stark picture. Two distinct eras, basically. Decades of almost unstoppable growth, followed by this sharp, accelerating downturn over just the last couple of years. Management's now calling it a transition year.
A transition year, that sounds expensive.
It is. And the scale is still huge. Let's get a baseline number out there. Nike is still the world's largest seller of athletic footwear and apparel, no question. But for their fiscal year 2025, which just finished, total revenues fell significantly, down 10% to $46.31 billion.
Wow, 10%. That's not just a blip. For a company priced for growth, that's a major contraction, right?
Exactly. That's top-line shrinkage for a brand investors basically assumed would grow forever.
And with a $46 billion company, every point drop is massive. So to really get why some of these strategies went wrong, we need to appreciate just how big this operation is. Fundamentally, Nike's about shoes, right? Footwear is the engine.
Absolutely. Footwear generated, was it $30.97 billion in FY25? That's about 67% of total revenue.
And apparel is the other big piece.
Right. Strong complement. About 33%, $15.27 billion necessary. But footwear drives the identity, and the brand portfolio itself is incredibly focused, maybe too focused. That's part of the issue. You've got the main Nike brand, the mothership, and then you have the Jordan brand, which is just this cultural phenomenon,
Oh yeah, Jordan's huge. Moved way beyond just basketball.
Totally. It's a multi-billion-dollar global force, sets trends in youth culture, lifestyle, really.
But there's another piece often overlooked. Converse.
Yeah, Converse. It's a wholly owned subsidiary, and the sources highlight it's really struggling. Revenues there dropped a sharp 19% in FY25.
19%. Ouch. That suggests the problems aren't just about the main Nike brand strategy. It's broader execution issues, too.
Precisely. It adds another layer of complexity to this whole turnaround effort. Weakness across the board, in a way. Now, if we look at where the money comes from geographically, you can really see where the pain points are. North America, predictably, is the biggest chunk, $19.57 billion. Then EMEA, Europe, Middle East, Africa, that's about $12.26 billion.
And those are okay, or just softer?
They're facing some softness, yeah. But the real headache, the structural problem that's probably keeping executives up at night, it's Greater China.
Great. I remember China was supposed to be the engine, the future growth story for Nike. What happened?
It's completely flipped. The pressure is severe. The sources even talk about a kind of lost decade narrative starting to form for Nike in China. Revenues fell 13% in fiscal 24, then another steep 10% drop in fiscal 25. And the signals are that negative trend is continuing.
Why? What's driving that reversal?
It's a double whammy, really. Partly cyclical, partly structural. Cyclically, you've got the broader economic slowdown in China, less consumer confidence, less discretionary spending. That hurts everyone.
Okay, standard macro pressure. Yeah. But you said structural, too.
Yeah, and this is the tougher part. It's the rise of really effective local competitors, brands like Anta and Li-Ning.
Ah, the domestic champions. This sounds like more than just market share.
Oh, it absolutely is. It's becoming a cultural battle fought on the retail floor. These Chinese brands, they've dramatically upped their game in the last 5 years. Better product quality, much better design, slicker supply chains. But their killer advantage, it's tapping into nationalist sentiment. Guochou, they call it, national trend.
So buy local is a real force there.
A huge force. It's active pride in Chinese brands. Sometimes there's, tacit government encouragement. Geopolitical tensions don't help either. Makes buying American brands feel less appealing for some.
Yeah.
Anta, for instance, their marketing is all about Chinese heritage, Chinese athletes. They connect locally in a way Nike, as a foreign brand, just fundamentally can't.
So Nike's losing share not just on price or product, but on patriotism almost.
Essentially, yes. And countering that kind of preference shift, that's incredibly difficult. It's arguably one of the toughest strategic challenges Nike faces anywhere in the world right now.
That's critical context.
Yeah.
You can wait out an economic dip, maybe, but a shift in national preference, that's a much deeper problem. Okay, let's pivot from external pressures to maybe the biggest self-inflicted wound. That huge strategic bet on the consumer direct defense, the DTC push.
Right, the big pivot.
The vision, I remember, sounded pretty good on paper. Take control, get better data, capture higher margins by cutting out wholesale partners. Sell direct through Nike stores, apps, the website.
And they went for it, hard. We really need to stress the scale of this withdrawal from wholesale. Nike systematically, deliberately cut ties with thousands of retail partners. Small shops, big chains, thousands of them.
Thousands, wow.
Yeah, they basically slashed their physical footprint from something like 30,000 retailers down to maybe 3,000 curated ones. Even big partners like Foot Locker had to meet really strict Nike standards for presentation.
They really bet the farm on DTC being the future.
They did. Billions were riding on it.
But the data, as you mentioned, shows it didn't work out. Consumers didn't just switch over. Why did that bet fail so badly to make up for the lost wholesale sales?
Well, the sources point to a few core reasons. First, that assumption that post-pandemic everyone would stay glued to digital shopping just didn't happen. People flooded back to physical stores, multi-brand stores. That's where discovery happens, right? You see different brands, try things on in one go.
And Nike wasn't there as much anymore. They'd pulled back.
Exactly. They created a vacuum on the shelf. People went looking, and Nike's presence was diminished. Second, their own digital execution, despite all the investment, wasn't perfect. The sources suggest friction points persisted, things like complicated returns, stock availability issues, maybe not being able to browse the whole range as easily as on a multi-brand site.
So they lost the convenience of the local store, but didn't quite nail the direct digital experience to compensate.
That seems to be the story the numbers tell. And the data confirms the damage. Nike direct revenues, their own channels, down 13% to $18.8 billion in FY25. And the digital piece specifically, the supposed engine of high-margin growth, that looks particularly weak. Digital sales dropped a really concerning 12% in the first quarter of fiscal 26.
12% drop in Q1 26, after previous drops too.
Yeah, compounding earlier declines that were sometimes over 20% year over year. That digital weakness is probably the biggest red flag for a company that wanted to own the consumer relationship directly.
So they had to backtrack.
They had to, a rapid tactical retreat. Management calls it a tacit acknowledgement that going all in on DTC left a massive hole in their distribution. So now Nike is very publicly re-engaging with wholesale partners, admitting basically that they need these retailers to scale our innovation and newness in physical stores.
They need the shelf space back. And is this U-turn showing results yet?
It is, surprisingly quickly. In that same Q1 of fiscal 26 where digital fell 12%, wholesale revenues actually grew 7%.
7% growth in wholesale?
Yeah.
That's significant.
Absolutely crucial. It was the key offset preventing an even bigger overall revenue decline. It just proves how vital that multi-brand channel still is, even for a giant like Nike. Scale and visibility matter.
So this painful shift back towards a more balanced approach seems necessary just to stop the bleeding on the top line.
Right. Necessary, but definitely painful, especially after investing so much in the DTC vision.
Okay, that strategic mess brings us squarely to the financial impact. The consequences of these channel mistakes, plus some operational chaos. This is where you see the internal struggles hit the bottom line hard. The reports talk about a sharp deterioration in key profit metrics starting around fiscal 2023.
Yeah, the numbers get pretty rough here.
And the initial trigger for that profitability shock was, what, the inventory crisis?
Exactly. A massive inventory crisis. It was like a perfect storm. Remember all those pandemic supply chain snarls?
Oh, yeah. Stuff stuck on ships for months.
Right. So suddenly, a huge wave of late-arriving products, shoes, clothes meant for sale 6 months earlier finally hits warehouses. But it hits just as consumer demand globally starts to soften. Bad timing doesn't even begin to cover it.
So too much stuff, arriving too late when people are buying less.
Precisely. And the scale was staggering. Inventory ballooned 44% to a record $9.7 billion in the first quarter of fiscal 23.
Nearly $10 billion in inventory. Wow.
Just a mountain of stock, tying up cash, going out of style fast. It was a colossal failure of forecasting and logistics.
And you can't just sit on almost $10 billion of extra shoes and apparel. You have to move it, which means
discounts, heavy discounts. It forced Nike into what the report calls a highly promotional stance.
So what did that look like for consumers? Just sales everywhere?
Pretty much. They flooded their factory outlet stores, their own website, lower-tier wholesale partners, basically anywhere they could shift volume with deep discounts. A fire sale, essentially.
Just trying to clear the decks.
Right. And that process, which took several quarters, absolutely hammered their gross margin. That's the key vulnerability, the first big hit to profits. Gross margin, which Nike historically kept in the elite mid-40% range, fell sharply. From a peak of 46.0% in fiscal 22 down to 42.7% in fiscal 25.
That's a big drop in core profitability per sale.
Huge. And the latest number, Q1 of fiscal 26, was 42.2%. So the pressure is still on. It's lingering discounts, maybe some cost pressures, tariffs. But mostly, it's that margin they lost trying to fix the inventory mess. Pure profit gone.
And that flows down the income statement, right? What about operating margin, the overall efficiency?
Even starker. Operating margin really shows the core business health. It hit a 5-year low, just 8.0% in fiscal 25.
8%? What was it before?
It was 16.2% back in fiscal 2021.
So it got cut in half, basically, in just 4 years.
Pretty much. Nearly half the operating efficiency gone. And that 8.0% figure, that's the real double whammy. It reflects lower prices from the discounting and all the sustained high-cost selling, marketing, admin expenses, all the money poured into the DTC pivot that didn't pay off, and now the costs of repivoting back.
Running harder just to stand still or even slide back profit-wise.
That's a good way to put it, capturing less profitable sales despite huge efforts.
Okay, but for investors thinking longer term about the fundamental health, I want to talk about the returns on capital, because that's the ultimate test, right?
Yeah.
Does the money invested actually create value?
This is where it gets really concerning, possibly signaling a structural issue, not just a temporary dip. Let's look at return on invested capital, ROIC. For a business like Nike warehouses, stores, R&D, big assets, ROIC tells you how efficiently they use every dollar they invest back into the company.
And Nike used to be amazing at this.
World-class. Elite. In fiscal 2021, their ROIC was 26.4%. That screams great management, strong brand power, super effective capital use.
And now, fiscal 2025.
Plummeted, down to just 12.4%.
Wow. Less than half. So the billions spent recently on DTC, on inventory, on logistics, are generating way less profit per dollar invested.
Significantly less. Less than half the return compared to just a few years ago. That kind of collapse isn't just a bad quarter. It suggests the capital deployed hasn't been productive. It raises real questions about capital allocation decisions.
That does sound like a potential systemic break. And return on equity, ROE, same story.
Same story. ROE collapsed too. From 55.0% in FY21 down to 23.3% in FY25.
Okay, 23% ROE still sounds decent in absolute terms.
It does in isolation. But the drop of over 30 percentage points is the alarm bell. It quantifies how recent strategies just haven't delivered that historic elite economic value investors expected from Nike.
It really suggests their competitive mode, that brand premium, might be shrinking faster than people thought.
It strongly suggests that, yes, a real wake-up call.
Okay, let's widen the lens now. Contextualize this. Is the whole sportswear market just in a slump? Is everyone struggling?
Not really, no. That's what makes Nike's situation more pointed. The global sportswear market is huge, around $336 billion in 2023. And it's actually growing. Forecasts are for steady, mid-single-digit growth. Think health trends, athleisure, that's all still going strong.
So Nike's contracting while the overall market is expanding.
Right. They're struggling against the tide, which makes their internal issues even more glaring.
And this must mean they're losing market share.
They are. The numbers are pretty clear. Between 2019 and 2024, the two giants, Nike and Adidas, together lost about 3 percentage points of global market share. That share went to smaller, faster rivals. For Nike specifically, their global share slipped from 17.1% down to 16.4%.
Doesn't sound like a lot, 0.7 points, but at their scale.
It's billions in revenue, billions that flowed directly to competitors, particularly these newer disruptive brands.
Okay, Adidas is trying its own turnaround, we know that. But who are the real disruptors? The ones really outperforming Nike financially right now?
Well, you have to mention Lululemon first, just for sheer profitability. Their operating margins are consistently over 22%. They own that premium athleisure space. But the direct assault on Nike's performance credibility, the ones attacking the core running identity, that's On Holding and Hoka.
The Swiss brand On and Hoka.
Yeah. The sources pinpoint these two as the most significant disruptive threat. They're successfully taking share and, maybe more importantly, mind share in running, which is the category that historically gave Nike its technical halo.
Let's talk tech for a second. On has that distinctive cloud tech sole, right? Those pods.
Exactly. Segmented clouds. Offers a unique feel, responsive but cushioned. Popular with serious runners, good design appeal too.
And Hoka is the opposite extreme almost, the super thick maximalist soles.
Right. Hoka really nailed that trend. Oversized, ultra-cushioned midsoles, huge appeal for distance runners, but also everyday wearers looking for comfort and joint protection. It was a direct rejection of the old minimalist trend.
And why are these two succeeding now where maybe others failed before?
They tapped into something about modern running comfort and performance needs, and they moved fast. Plus, their financial results are just explosive compared to Nike's recent stagnation. On reported, 43% sales growth in Q1 2025? Hoka's seeing huge double-digit growth too.
43% growth for On, while Nike is shrinking.
Stark contrast, isn't it? They're connecting through rapid product cycles, very targeted marketing, often grassroots, hitting the specialty running stores hard. And remember, those were the stores Nike had partially pulled back from with the DTC push on, and Hoka filled that gap.
Right. That brings us to this halo effect risk you mentioned. Explain that again. Why does losing ground in serious running shoes matter so much when most of Nike's money comes from, say, lifestyle sneakers or Jordans?
It's absolutely critical to grasp this. Performance running, historically, that was Nike's engine of brand authenticity. The breakthroughs they made for elite marathoners, think Air technology way back, or the recent Vaporfly shoes that created this powerful halo effect. It proved Nike was the best, the fastest, the most innovative, technically superior.
Okay, so the tech validated the whole brand.
Exactly. And that halo allowed them to command premium prices and maintain this perception of superiority across their entire range, even on a $150 casual sneaker that has zero tech from a racing shoe. If On and Hoka start to own that technical credibility in running, the halo fades. Nike risks becoming seen as just a huge fashion or lifestyle brand first, and maybe a performance brand second, and that distinction, in terms of long-term pricing power, it's worth billions.
So the runner choosing On or Hoka might subtly influence the teenager buying Air Force Ones, making them think Nike isn't quite as cutting edge anymore.
Precisely. It chips away at the core, just do it promise on the performance front. Now, that said,
The moat is still there.
the moat is still huge. Don't underestimate Nike's intangible assets. The swoosh itself is iconic. Their marketing power, their massive roster of global superstar endorsements, that's still a massive barrier to entry. Smaller rivals can't just replicate that overnight. It buys Nike time. Time to execute this turnaround.
Which brings us to the plan itself. Management seems to be admitting the mistakes, right? They've been pretty open about strategic errors and needing a fundamental reset.
Yeah, surprisingly transparent, actually. It started with big leadership changes in late 2024. Elliot Hell took over as CEO in October, and then they rolled out this strategic Win Now action plan in May 2025.
And the reorganization seems key. New faces or maybe old faces in new roles.
It signals a major cultural shift. They retired the executive who really drove that aggressive DTC strategy, and they elevated trusted Nike veterans, people like Amy Montaigne, Phil McCartney, into roles with huge influence over product innovation, brand storytelling.
So shifting power back to the product people, away from the channel managers.
That seems to be the clear message. Get internal influence back towards making great stuff and telling great stories about it. Less focus on just the channel strategy that, frankly, failed. Break down silos, speed up real performance innovation. That's the goal.
And the core of that, getting the halo back, is doubling down on product innovation. A multi-year innovation cycle, they're calling it.
Right. And it's not just talk. They're fighting back directly in running, targeting Hoka and On. The tactical response is specific. They're launching the Pegasus 41. That's a huge update to their biggest running shoe franchise.
Okay, updating a classic.
But more revealingly, they launched the Pegasus Premium. This shoe features a totally new sculpted air zoom unit. It's all about maximizing energy return and cushioning.
So directly countering Hoka's cushioning and On's responsive feel with their own air tech.
Exactly. It's a technical counterpunch. They're trying to prove air is still the king and can deliver that modern comfort people want. And at the same time, they're pushing the super elite stuff like the Alpha Fly 3 marathon shoe to reinforce that top of the pyramid image, show they still lead at the absolute peak.
And beyond product, they're fixing the channel mess, rebalancing.
Yes, tacitly admitting the DTC experiment went too far. They're refining DTC now, focusing it on brand building, personalization, and crucially, full price selling. No more heavy discounting through their own channels, hopefully. That killed margins.
And rebuilding bridges with wholesalers.
Actively rebuilding those strategic partnerships. They need those multi-brand shelves back to get scale and visibility for their new innovations. Get them where people actually shop.
And marketing, still a huge part of their playbook.
Always. Leveraging the big global moments, Paris Olympics, the Euros, for bigger, bolder storytelling. Classic Nike. But the real power move, the competitive jab, was snatching the German football sponsorship away from Adidas in Adidas's home market.
Right, that was huge news. Talk about aggressive.
Pure competitive signaling creates maximum buzz, puts pressure on their biggest rival. It shows that even while struggling internally, Nike will still flex its financial muscle to dominate the conversation.
Okay, so despite all these challenges, we need to remember, Nike isn't broke. They still have financial muscle, right? A strong balance sheet.
Absolutely. They maintain significant financial flexibility, around $9.2 billion in cash on hand, and their debt is pretty low, a debt-to-equity ratio of just 0.55. Very conservative.
So that cash hoard gives them breathing room, time to actually execute this turnaround plan.
Massive breathing room. It's a crucial buffer that lets them navigate this painful multi-year fix without facing a liquidity crisis. And they've kept rewarding shareholders too, which has maybe papered over some cracks.
How so? Dividends and buybacks.
Yeah. Impressive track record, 23 straight years of dividend growth. They paid out $2.3 billion in dividends in FY25. Plus, they're working through a huge $18 billion shared repurchase program. Spent another $3.0 billion on buybacks in FY25.
Okay, so returning a lot of cash to shareholders. But here's the tension point, right? The disconnect the reports highlight. Where's that cash coming from?
This is the critical issue. The numbers show a potential problem, an unsustainable deficit in FY25. Total cash returned to shareholders' dividends plus buybacks was $5.3 billion.
Okay, $5.3 billion out the door.
But the company only generated $3.3 billion in free cash flow during that same period.
Oh, so they paid out $2 billion more than they actually generated in cash.
Exactly, a $2.0 billion deficit.
So where did that extra $2 billion come from?
Came straight from drawing down that big cash balance we just mentioned. They funded part of the returns by eating into their savings, essentially.
Is that normal? Or is it a sign they're trying to prop up the stock price while the business struggles?
It's not sustainable long term. It could be confidence in a quick recovery, or it could be pressure to maintain returns, likely a bit of both. But the clear implication is they cannot keep returning cash at this rate, $5.3 billion a year, unless profitability and free cash flow bounce back strongly and soon in FY26. And that high dividend payout ratio, 71.5%, because earnings are depressed, that also limits how much they can reinvest back into the business. R&D, innovation, supply chain fixes, the very things needed for the turnaround.
So the commitment to shareholders is potentially starving the investment needed to fix the company. That's a tough spot.
It's a very tightrope they're walking, a huge risk. If cash flow doesn't recover fast, those buybacks have to slow down, or maybe even that dividend growth streak comes under pressure.
Which would send a terrible signal to the market.
A terrible signal. They need to balance investor expectations with the real needs of the business turnaround.
Okay, this inherent conflict leads us perfectly into valuation, which sounds like a real puzzle right now.
It is complex. Nike trades at a high price-to-earnings PE ratio, around 32 times earnings.
32 times? That sounds expensive.
It does, but remember, that's based on depressed earnings. The E in PE is low right now. But if you look at price-to-sales, PS, it's around 2.2x, which is actually quite compressed compared to Nike's history. They often traded at 4x or even 5x sales when things were booming.
So expensive on earnings, cheaper on sales. How does that compare to competitors?
That's where the paradox really hits you. The analysis shows a striking anomaly. Nike trades at a premium PE multiple, despite having negative revenue growth currently, and the lowest operating margin, that painful 8.0% among its major peers.
Wait, so companies growing faster, making more profit per sale, like Lululemon with its 23% margin, they trade at a lower PE than Nike?
In many cases, yes. It seems counterintuitive.
Why would that be? What's the market thinking?
The market is entirely looking through the current problems. That high valuation isn't based on today's weak results. It means investors are betting heavily on a successful and relatively quick turnaround. The price implies an expectation that Nike will get revenue growth back into that mid-single-digit range, 4–6% pretty soon, and crucially, get operating margins back up from 8% towards maybe 12–13% in the near future.
So current price already assumes the turnaround works.
To a large extent, yes. Which makes the investment thesis right now fundamentally a bet on that battleship turnaround actually succeeding.
Okay, let's spell out that bet. The bull case, what do you have to believe for the stock to work from here?
The bull case rests on the power of the brand and Nike's sheer scale. You have to believe the strategic fixes re-engaging wholesale, refining DTC will stabilize revenue. You have to believe the multi-year innovation cycle, things like the new Pegasus line, will genuinely work, win back share from On and Hoka, and reignite that performance halo. And you need China to stop declining and at least stabilize. Basically, the bull case says management's errors were temporary bumps, the brand's core appeal is intact, and they'll get back on track.
Okay, and the bear case, what's the argument against that?
The bear case argues the damage might be more permanent, that the threat from On and Hoka isn't just cyclical, it's structural. They've potentially stolen the innovation mantle for good in key areas. It contends the halo effect is broken or severely diminished, and maybe because they have to rely more on lower margin wholesale partners now, they simply can't get back to those peak profitability levels of the past. So if the recovery stalls, the stock looks very expensive at current levels, and that pressure on capital returns becomes a major problem.
Bulls bet on the brand's resilience. Bears bet the competition and strategy shifts cause lasting damage.
That's the core tension. And for you, the listener, trying to figure out which way this is heading, the sources identified 5 key metrics. Think of this as your checklist for tracking the turnaround's progress in the coming quarters.
Okay, what should we be watching?
First, and probably number 1, gross margin. You absolutely need to see this stabilize, then start ticking up sequentially, quarter after quarter. That's the clearest sign that discounting is over, the inventory is clean, and they're getting pricing power back.
Got it. Gross margin recovery, what's second?
Second, revenue growth in Greater China. Can they stop the double-digit declines? Can they get it back to flat or even slightly positive? Stabilizing China is essential for the overall revenue story.
Okay. China's stabilization. Third,
Nike brand digital sales. After those big drops, they must get digital back to positive year-over-year growth. It needs to prove the refined DTC strategy is actually working, attracting online shoppers at full price.
makes sense. Validate the online channel fix.
Yeah.
Fourth,
Sell-through of new products. How well do the new shoes like Pegasus 41 and Premium actually sell? Are people buying the innovation? This is the real-world test. Is the product pipeline hitting the mark against the competition? Watch for reports on market reception.
right. Are the new shoes actually popular? And the fifth metric.
And finally, 5th, free cash flow conversion. Does free cash flow recover strongly, enough to comfortably cover those big dividend and buyback commitments and fund necessary investments? They need FCF to bounce back to take the pressure off that cash balance and prove the whole financial model is working again.
Okay, 5 key things to watch. Gross margin, China revenue, digital sales, new product sell-through, and free cash flow. That's a great takeaway list. What a fascinating and kind of humbling story. We've really seen today how even the most dominant, iconic global brands aren't immune, not just to market trends, but to, self-inflicted wounds. Strategic mistakes like that DTC overreach, the operational chaos of the inventory glut, and just failing perhaps to react quickly enough to focused, agile competitors like On and Hoka. Nike is definitely in a tough but necessary transition year.
Absolutely. A painful reset.
And the analysis today suggests Nike's biggest challenge maybe isn't just about selling more shoes in the short term. It's about selling the idea of performance, of innovation, convincingly again. If these challenger brands, On and Hoka, if they really do manage to capture and hold that mantle of authentic athletic performance, can Nike's massive marketing machine and cultural status overcome a real persistent loss of its technical edge? Or does that sharp collapse in their returns on capital, that ROIC falling from over 26% down to just 12%, does that signal something more permanent? A structural hit to the brand moat that means the days of Nike commanding those extreme premium valuations might actually be over. That question about the long-term durability of their pricing power and their technical leadership, that feels like the most critical thing worth exploring as you do your own research.